You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Ghalid Bagus, who is a principal and financial risk management consultant with a very, very major company that lots of individual investors haven't heard of called Milliman. Ghalid, a real pleasure to have you.
Thank you, Doug.
So before we dive into some of the detailed questions, tell us a little bit who Milliman is and what is the risk management business all about?
So Milliman is one of the world's largest financial risk management and actuarial advisory consulting firms. Most individual investors would not have heard about Milliman before, but most institutional players around the world would know who Milliman is. And so what we do, mostly in my unit, is provide financial risk management services to large financial institutions around the world. We've also expanded our business now to, through those large financial institutions, provide risk management of client portfolios directly to the underlying investors.
Okay, so that's in fact why you and I are here today, because the types of people who listen to the Goldstein on Gelt show are, they're people, they're not institutions, but many of them are concerned certainly about the volatility and the risks in the market. So what are the main risks that investors face in their portfolios today?
Well, if you think about investors and anyone who's investing, whether it's individual or institutional, they all have the same goals. People are investing for a purpose. And with individual investors, the purpose is largely to draw an income from those investments at some point in the future. So the key risks as we see it that investors face in their portfolios is firstly, there's obviously a market risk that everyone is aware of, that there are fluctuations in the market, sometimes extreme fluctuations that would impact the income that investors could draw from those portfolios in the future. There's also a liquidity risk that investors face in the fact that the assets that they have at their portfolio at any point in time, they may not be able to sell those assets at a reasonable price to provide for the income that they need.
Mm-hmm. So you spoke about market risk and liquidity risk. The solution that we've always heard people talk about is try to look beyond the short term. And if you're a long-term investor, then all of those things kind of just flatten out over time. You don't remember the ups and downs. Do you think that's true?
Well, if you think about the main way that people construct portfolios, it is sort of based on taking the long-term view. So people would, for example, look at equities and say, well, in the long run, this is the return, this is the volatility. For bonds, in the long run, this is the return, that's the volatility. And so if I put together a portfolio of equities and bonds over the long run, it should be fine. But that ignores the behavioral aspect of investors. And it's very hard for investors over the short term to sort of, when these market events happen, to sit back and say, well, I'm just going to ride it out.
Right. That's very true.
That's borne out in all sorts of studies. If you look at some of the studies, what you see is that you'll see a return for large cap stocks. And then you look at the return that the average investor in large cap stocks received, and that's much lower, sometimes 2 or 3% lower over time. And the reason for that is that investors are emotional. They buy, just after the markets run up substantially, and they sell when markets are low. So it's good to take the long term, but it's the short term effects that make investors make decisions that sometimes lead to very bad impacts on the portfolio.
Mm-hmm. So what you're saying is it's a lot to do with the emotional side or the behavioral finance issues as opposed to the markets themselves.
Yes, it's related to the fact that investors are making these decisions, when there are extreme swings in the market, and usually it's very disastrous for the portfolio. If you take one example, if you just look at what happened at the end of 2008, we had an extreme market correction in almost all asset classes. what investors did was they immediately went into cash or a lot more stable investments. And then 2009 was one of the biggest bull markets that occurred. And throughout that year, most people were still sitting in cash, even though the market rallied substantially. So if you could take out the ability or that emotional aspect, if you could remove it from investing, investors could have a better experience over the long run.
All right. We're talking with Ghalid Bagus, who works with an institutional risk management company called Milliman, but that company is now actually getting more and more available to retail investors, individuals who want to protect their portfolio. Ghalid's been talking to us about market risk and liquidity risk, and one of the things he pointed out, which I have certainly seen in my 20 plus years on Wall Street, is that the investments might be okay, but the way people handle them can actually be devastating. And so even though we'll often talk to a client about being a long-term investor and the importance of that, that doesn't always help when things look so awful that people end up just selling out. So Ghalid, tell us, what does it mean to hedge a portfolio? How's this actually done?
So the way we would manage the risk in a portfolio, there are two steps to that. The first thing that we would do is manage the volatility of the portfolio. Now, if we go back to something we mentioned earlier, where we said we look at the long-term volatility of equities and bonds, and then you put together a portfolio for an individual investor, and maybe that investor is a moderate investor. And so you would put together a portfolio that is maybe 60% equities, 40% bonds. Well, that portfolio over the long run will have a 12% volatility. Now, if you look at 2008, though, that portfolio would have had a volatility close to 50%. Wow. So the moderate investor gets really scared when he sees 50% volatility. And by volatility, we mean just how much that portfolio is fluctuating on a day-to-day basis. So the first thing we do is we run a strategy to manage the risk that ensures that the volatility, the 12% volatility you're expecting for that portfolio, is not just what the portfolio achieves over a long period of time, but also over very short periods of time. So what would have happened in a 2008 scenario, there would have been an overlay to manage that portfolio's volatility down to 12%. So even when the rest of the market is extremely risky, moving around quite substantially, the client looks at their portfolio and there is still movement that is equivalent to a 12% volatility. And so they would then not be less prone to making those decisions that they would have made if their portfolio is fluctuating around a lot more.
But if you limit the volatility to 12%, doesn't that limit it on the upside as well as the downside?
Well, the key thing is that if you look historically, what you'll see is that markets tend to go up with low volatility and they tend to go down with high volatility. And that's, it's sort of behavioral as well, because investors, when markets are going up, they're not panicking, they're very calm, and so they make sort of reasoned decisions about investing. Whereas when the market's going down, there's a lot of buying and selling, there's a lot of emotion, and so there's a lot more volatility in the market as the market's declining. But to achieve your stable level of volatility over short periods of time, what you're then doing is, when volatility is low, you're over-allocating to the growth assets, the equities in this case, and when volatility is high, you're under-allocating to those. And so over time, you may see an improvement in performance by, being overweight the equities in low volatility environment and underweight the equities in a high volatility environment.
So are you just looking at the difference between volatility? In other words, is that your measure, or are you looking at the height of the market? When the market goes up a lot, people go, wow, it's really high. It might go down, but that's not always true. Sometimes it keeps going up. So is volatility the key measure here?
Well, that is one of the key measures. We look at volatility, and so as we are obviously trying to manage to a given level of volatility, the current level of volatility in the market is a key determinant of how much exposure you're going to have to the equity market. So obviously, if it's not directional, it's not that we look at, well, what has the market done? Has it been running up? Okay, we're going to take some exposure off the table. That's not how it works. It's more a view of volatility and where we need to be in terms of volatility for the portfolio.
It sounds to me like in order to make these decisions, you need to have some level of prophecy, because we can always talk about how the market has been. This week it has been very volatile, or this month it has been very volatile. But how do you know what's going to happen tomorrow? Aren't you making some sort of, well, let's say prediction or prophecy if you're on the biblical side of things?
Well, that is true to some extent. But if you've done any sort of studies on volatility, and I don't want to get too technical here into how the different volatility models work. A very good predictor of volatility tomorrow is actually volatility today. Okay. There are various measures of volatility in various different models you could use, but you can, in most instances, come very close to the volatility for tomorrow by looking at the volatility of today, with some different measure of how you weight your observations in the past for calculating that volatility.
Okay, but, so I just want to differentiate. I believe you're not saying that past performance is an indication of future returns in terms of the stock market, meaning if the market went up yesterday, it doesn't mean it's going up today. But you're saying that if there was volatility previously, then we can assume that may continue to some, within some parameters.
Yes, exactly.
All right. Wow. There's a lot going on, and I have many, many questions, but unfortunately we're nearing the end of our time. But let me just leave with one more question. When people try to hedge their portfolio, doesn't that end up cutting off their upside? Because if you're out of the market and then it shoots up, you've missed it.
That is true if you compare your portfolio to a naked portfolio. So, for example, if you look at large cap stocks hedged and just pure large cap stocks, there is some give up on the upside. But the way we look at it is not to compare it against large cap stocks. If you want risk management for your portfolio, you would never have been 100% invested in large cap stocks. You may have been invested 60% large cap, 40% bonds. So the true comparison is against an alternative that you would have invested in. If you were 100% in large cap stocks naked, then you don't need risk management if you are that type of a risk taker. But for people who want risk management in their portfolio, the true comparison is, how does my equities with hedging or with some risk management overlay compared to my alternative, which is a 60-40 or 50-50, depending on your risk profile. So that is what we view as the true comparison for a hedged portfolio.
Okay. I think that sounds to me like an intelligent way to look at it. You have to compare, as it were, apples to apples, or at least what you would otherwise be doing if you weren't involved in a hedged portfolio. Ghalid, this has been fascinating. We're unfortunately out of time. Tell me in the last few seconds, how can people learn more about you and the work that you're doing?
Well, they can go to our website, milliman.com/FRM for financial risk management. And we have a lot more information on the work that we do in the different capacities, white papers that we've written, research that we've done on that website.
Okay, so we will put a link to that at the show notes of goldsteinongelt.com. Ghalid, thanks so much for joining us today.
Thanks, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.